One of the main themes that we're going to be talking about today is the fact that savings rates, which in theory should also be increasing as interest rates increase, are not giving the same returns that savers might expect in terms of comparing that with what they're having to pay now in extra mortgage rates.
No, they are going up. Savings rates have increased because banks, frankly, can afford to try and encourage people to save. Of course, banking has changed from the days when the model was we would give them money to look after for us, and then the money some consumers gave, they would lend to others. But rates, again, end of the first week in July, above 2.4%, 2.5%. Remember that mortgage figure, 6.5%. That's a 4% margin. That is very healthy. You go back to just before the interest rate hiking began at the bank, when savings rates were bumping along just above zero, the margin was 2%. So the margin has doubled, and that is what consumers have definitely noticed, a lot of media have noticed, and the government has noticed, and that's why the banks essentially are on notice to provide better deals.
Okay, good time to bring in Danni. You know, Danni, if you're a consumer right now and you're feeling squeezed at every angle, you're paying a lot more for your mortgage, you're worrying about making ends meet, and then you're seeing that you're not actually even benefiting from having savings in the way that you might expect, you'd be, within your rights to think, what the heck is going on here?
And I think a lot of consumers are thinking exactly that. There is an awful lot of anger that they seem to be squeezed on every side, particularly because, as you say, it's incredibly quick for those mortgage rates to go up seemingly almost on a daily basis. But of course, then we get the savings rates not responding in the same way, particularly if you stick with your sort of traditional accounts, those easy access accounts. That said, I think the consumer has to bear some responsibility here, because there are much better rates out there if you are prepared to look for them, particularly if you're prepared to hunt for them online, and particularly if you're prepared to lock your money up for a year, 2 years or so. Then you can get a pretty chunky deal. In fact, the best one-year bond is paying 6.1% now. Of course, factor in inflation, it's still losing money, but it's much better than the amount that we were seeing that Paul was just talking about, that sort of 2% amount. So there are deals to be had. And I think, we've got used to not chasing those deals because we've had over 10 years where interest rates have been so low, and because inflation has been so low, that those savings accounts with decent chunky returns just haven't been out there. So people have looked elsewhere. They've looked at equities, those kind of investments, but they haven't got used to looking for better savings rates. And I think that's definitely what they need to do.
Yeah, that's an interesting point, isn't it? People have been so used to these interest rates that have been so low for so long that it may not have been on their radar. But now, of course, you can make some money on your savings. What would you advise people who do have some savings at the moment, but certainly aren't getting the rates that they might deserve in their instant access savings accounts?
I think they need to look at other instant access savings accounts. So according to Moneyfacts, the best one at the moment is paying 4.35%. So that's not a bad rate. If you are prepared to lock your money up for a year, 2 years, you can certainly get a better return. Though, of course, with the cost of living crisis the way it is still, and we talked about the fact that energy costs have come down a bit. Well, my energy bill has just gone up because my direct debit wasn't covering enough. So people do need to make sure that they still have enough cash in an easy access account to cover at least 3 months, preferably 6 months of bill in the worst case scenario. But, I think another thing that people really do need to think about is there was an awful lot of savings amassed during the pandemic because people weren't going out, and those lucky enough to still have a job, to not be furloughed, they managed to put aside quite a bit of cash. And as interest rates have started to creep up, and as wages have started to creep up as well, those accounts have grown. And now some people are finding for the very first time that they're having to pay interest on their savings. So there is something called the personal savings allowance, which allows a basic rate taxpayer to earn £1,000 in saving interest every year. and a higher rate taxpayer £500. For an additional rate taxpayer, it is nothing at all. So there are a number of people now bumping up against that limit, bumping up to a point where suddenly they're finding that they're having to pay tax on their savings interest. So if you do find yourself in that situation, you might want to consider looking into a cash ISA. For the longest time, cash ISAs, their interest rates were pretty terrible. So people were thinking, just don't bother with that. Just stick it in a cash savings account, leave it there. It'll be fine. It'll do better. Now it might really be worth doing the sums to see whether or not it might be better to get a slightly lower interest rate in a cash ISA. You can put £20,000 in a year. It is a tax wrapper, and that way you will not face tax on your savings interest. And we did have some numbers out from the government not that long ago saying that it expected to rake in £6.6 billion in tax over the next year. That is from savings interest, and that is up from 3.4 billion. So that just demonstrates how much money is out there, which wasn't facing these tax payments and now suddenly is.
Wow, good advice there. People may now find themselves having to pay tax on their savings for the first time this year, and good advice, really checking out ISAs.